Good morning to our viewers. Good morning to our listeners. I am so excited to welcome you to Coffee Time with Marie Torossian, CPA. For those of you who are returning to see us, thank you so much for coming back. I hope you're getting so much value, and that's what's bringing you here. For those of you who are joining us for the first time, we love having you here as well. And make sure to put a thumbs up or a hands up in the chat so we know you are new. I want to encourage everyone to make sure to subscribe to the channel or the page you are watching us at or listening to us. We are going live on video, basically live streaming on Facebook, LinkedIn, and let's see, YouTube. And we are also on 9 different podcasts. So make sure to check out Apple Podcasts, Google Podcasts, if you want to listen to us on the go. I am your host, Marie Torossian. I'm a certified public accountant and a chartered global management accountant, an experienced auditor and a CFO. I have the creator of the Valuation MT methodology, which I am using specifically to help my clients go from their first million to 10 million and more. I've also authored a couple of books. One of them is an ebook, the Business Owner's Guide to Operational Accounting, and I'm going to put the link in the chat. And on the banner, you'll see it going through. And the other one is the Complete Guide to Business Growth, and that is available on Kindle, and I'll put the link on that as well. I have some big news that I wanted to bring it to you today. I am officially a Grant Cardone licensee, so I will be bringing even more value to my clients with coaching in sales and marketing. I am super excited. So if you want to find out more, I'm going to put a link on that as well, and let's start chatting about this. So as you all know, my weekly guest is my friend and tax colleague, Pedro Gonzalez. He is a business and tax strategist. I'm going to bring him in on board right now. Good morning, Pedro.
Good morning. Good morning. Good morning.
And then today, ladies and gentlemen, we have a super special guest. We have with us David Shier, Area Branch Manager for Movement Mortgage. And I'm going to read this because I want to make sure I do not mess up anything. David is a professional with more than 20 years of experience in the mortgage industry. He implements a consultative approach with all of his clients. He takes the time to ask questions and learn about their credit and financial status, as well as their future financial plans. His background, this is so cool. His background is in accounting and finance, which gives him a greater understanding of his clients' financial objectives and goals. This perspective provides a real value to his clients. And with that, David, I want to bring you on board. Welcome, David.
Good morning. Good morning. How are you?
Nice to have you.
Thanks for having me here, Marie. And thank you, Pedro. I'm so excited. Super excited. Thank you. Good morning.
Good morning.
Yes. You are our first special guest. We are really excited. I don't know if you
I feel honored. I feel honored. Thank you so much. Thank you.
So I wanted to briefly, and I want to make the most extended amount of time of here to make sure that we capture all the information you want to give us to our viewers and our listeners. But before that, I want to just do a quick reference to what we've covered in the past. Pedro and I have talked about self-employment. We've talked about taxes. We've talked about partnership agreements. We've talked about gig work. We've talked about hustling. We've talked about mindset. We've talked about so many interesting, cool things to help our entrepreneurs and business owners. And I really want to advise everyone that's watching and listening to please go back and check the replays to make sure you get the most out of all the information we're putting out there for you. And of course, don't forget to subscribe, like, and share everything that you're learning. And with that, today we have David here because we wanted to talk about mortgages for self-employed individuals. This is a very serious thing because it seems to have such, most self-employed people have such difficulty getting mortgages, right? So David, we are so happy to have you as our expert to speak about this. So I will open the floor for you, kind of like jump in.
Sure.
Where do we start? Where does a self-employed individual start?
Okay, thank you so much. Again, thanks for having me here, Marie and Pedro. Like Marie said, I work for a company called Movement Mortgage. Everything I'm about to say is obviously my views and not necessarily the company's. And I'm required to say my license number because we're very highly compliant. It's NMLS 367620. So having said that, let's get to the good stuff. Self-employed individuals is it could be a very anxiety-producing topic. I myself have been an entrepreneur. I've been in that same situation where, obviously the goal is to work as hard as you can, earn as much as you want or can earn. But at the same time, you want to minimize your taxes. That's why we're all here. I mean, it's to basically pay our fair share, but at the same time, we don't want to pay more than our fair share. So we want to minimize taxes. Having said that, the other side of that coin is that when you go to apply for a loan or specifically a mortgage, those same tax documents may be used to calculate your income. Okay. So that's why I'm here today, to explain how we overcome some of those perceived hurdles. First of all, let me just say this. For the purposes of being self-employed, a self-employed person in the mortgage world now is defined as anybody who owns 25% or more of a corporation. Okay. An S corporation, a 1065, so obviously a sole proprietorship. So if you own less than 25% ownership in a legal entity, you're not considered self-employed, even though you do have ownership. Okay. So in that case, we're only going to use whatever it is you get paid from that corporation in the way of regular ordinary income in terms of W-2 wages, commissions, bonuses, salaries. Okay. If you have ordinary losses pass through to a K1, we will not consider those because you own less than 25%.
Understood.
Okay?
Interesting.
So you have to own 25% or more of a corporation to be self-employed. On the other hand, if you are a 1099 individual, let's say you're a nurse, you're a therapist, you work at a nail salon, you are considered self-employed as a 1099 individual. Okay. So I just wanted to clear that up first. The second thing I want to clear up is the following. A lot of times I have people come to me and they say, yes, I own the company, but I pay myself a salary. Why can't you just use the salary, right? So when we look at self-employed individuals, we take the W-2 earnings that you decide to pay yourself because you're setting your own salary. And then we take the ordinary income from the K1s and we put them all together in one bucket. So we don't care whether you call it salary or whether it flows through to the bottom line as K1. We put them all in one bucket, we blend them together, and that's where we start our analysis. So for example, if you pay yourself $200,000 a year, but you have $50,000 in net K1 loss, for us, you start at 150, not the 200 salary. Okay. And then what we're allowed to do is, thankfully, we're allowed to add back certain things, right? So anything that is non-cash related, the amortization, depreciation, depletion, all of those section 179 depreciation, all of that stuff we get to add back because they're not cash based.
Absolutely.
We're looking for a cash based income calculation, not necessarily an accrual based. Okay. So, and if I'm getting too technical, please let me know, because my job, my job is to have these individuals bring it to me and then let me do the hard work. But hopefully this is a good kind of high flyover. Another thing is, one of the things, in order to get a mortgage, you qualify based on something called debt to income. That is basically the numerator is all of your monthly debts off your credit report, plus the new housing payment divided by your gross monthly income. If you are a self-employed person, a lot of times those car loans that are sitting on your credit report are paid for by the corporation. We get to add that back as well. So if there's things that are being written off through the corporation and the corporation has already taken the hit for it, we get to add those back to income as well. So there's a lot of different things. So the point being is, I don't want people to get discouraged just because they necessarily think they don't show a high enough K1 or W-2 or too many expenses. There are different ways of looking at this that require a professional who understands, the tax returns and understands entrepreneurship to go and actually do the calculation.
Yeah.
Now,
this is a good one, because, if I may, because this is key, because I feel that most banks that do mortgages, or if most entrepreneurs that go talk to average mortgage provider, they won't. I don't know if they'll go through all of this or even explain why they will not use this or that.
Yeah, they won't. And most of it's because it's not that they don't want to, they're just not educated on it. Especially if we go to a commercial bank, they're so busy with business from their deposit base that if it requires any type of work and reconciliation, number one, they need the knowledge, and number two, they need the time. You have to really roll up your sleeves. I've had files where I've had 10 different corporations on one particular file. That's 10 different calculations. That's 10 reviews of, business tax returns. And that's why it's important that you find yourself a lender who has that experience in self-employed individuals. I tend to specialize in it because of my background in accounting and finance. I went my master's degree in tax. I held the CPA license up until 2017. So I understand that. I really do.
I think that makes it definitely very unique, David.
Thank you. I appreciate that. The other thing is, sometimes, normally we take a 2-year average in self-employed. Okay. So normally you have to be in business for 2 years or more.
Yes, I have heard that. Yeah.
Yes. Yeah. There are some exceptions. FHA will allow 1 year as long as you have previous history in the same line of work. Okay. So let's say let's go back to that nail salon owner. If you were a nail tech and then you decided you wanted to go out on your own and open up your own salon, if you've got 2 years combined being a 1099 nail tech, and then you're now an owner of an 1120S for 1 year as being a nail tech, FHA will allow that as part of their 2-year continuance. Okay. Now, here's the really cool thing. If you have 5 years or more in business and you have a good enough credit score as determined by some software that is given to us by Fannie Mae and Freddie Mac, a lot of times we only need 1 year's tax return. So typically it's a 2-year average. Why is that important? Because everybody knows that the last couple of years have been challenging for some people during the pandemic.
Absolutely.
Okay. So if you have a certain credit score, and typically it's like a 700 or above, and you've been in business for at least 5 years, there's a good chance when we run that 1 year tax return, let's say it's 2021, you're going to get the result where it's called a streamlined mortgage for self-employed individual. There's a good chance we only need 1 year, so you can drop off the bad year of 2019 or the bad year of 2020 or whatever that year is that's going to pull down the average. Okay, so a lot of people don't know that as well. So you'll hear, if you hear from your lender, I only need a 1 year return, it's because you've been in business for 5 years, you've got excellent credit, and that we can only go with the 1 year. And we only have to go with the 1 year. Okay, that's good. Yeah, that's good to know. Also, 1099, Freddie Mac, and again, I'm getting a little technical. Conventional loans are governed by Freddie Mac and Fannie Mae, and there's some differences. And Freddie Mac tends to be a little bit more gracious with self-employed individuals. If you're 1099, there's a good chance I only need 1 year. Again, if you have the history of being in that business. Okay, so that is the world of what I'm going to call traditional conventional mortgages. Right? There's a lot of flexibility. You have to roll up your sleeves. You have to know what the detail is. You have to ask the question as to how much of this debt's already going through the 1120S or the 1065, right? But there's also now the new trend. It's not new, but it's come back around again. Is what they call non-QM mortgages. What that means is they're non-standard, non-traditional mortgages. And the reason why I'm bringing this up in this podcast is because it's caught fire in the consumer world. I actually have people calling me up and asking me for certain programs. They don't necessarily know what it means, but they've heard about it. One is the bank statement loan. Okay. So what that means is that there are programs now for entrepreneurs. You must be self-employed. Again, you still must be self-employed for at least 2 years, and they will check that. Okay. I had an individual who was only self-employed for 1 year, and I could not do the bank statement loan. So what that means is we take your bank statements, whether it be personal or business, we add up the last 12 or 24 months business deposits, we average them, and we call that income.
Understood.
Okay. Yeah. If it's your personal return, there's no expense factor applied against it. If it's your personal bank statements. If it's your business bank statements, we then ask your CPA, or we use an industry average margin, an expense factor, to come up with the net income. That's been a very popular thing because cash in the bank doesn't always necessarily equal the 1120S or the 1065.
Right.
Okay. So, and then lastly, you'll hear something called the DSCR, debt service coverage ratio. That's really, really popular now. It has to be an investment property. And basically, we don't, in our industry, necessarily care about the income or the debt of the individual. What we want to make sure of is the house is self-sustaining in terms of its cash flow. debt service coverage ratio. So if the rental income covers at least 100% of the housing payment, including principal, interest, taxes, insurance, and HOA, there's a good chance we can do the loan. So you can see that there's a lot of different programs out there. And my encouragement for those that are self-employed that have heard that it's tough to get a mortgage, it's not necessarily true. It's only tough if you don't go to the right individual. You've got to go. You've got to go to the people. You've got to go to the people. And this is a little bit of a plug. You got to go to the people that know self-employed business. That's really, really important.
Absolutely. You know, it's so funny. It some of the things you said, it kind of applies to when they're trying to take even a business loan out, because it happened to me where actually I had to almost get into an argument after an hour chat with a very well-known bank representative trying to get a very small loan out for my business. And I had been a, self-employed and kind of a consultant on my own for like 3 years. And then now I have a firm, I have a name. And I had provided the tax returns, and this person was just stuck on her checklist and saying, well, no, it's not the same business. I'm like, it's the same business.
Right. And there's a continuity, whether you're 1099, whether
it doesn't matter.
If I have somebody who was Schedule C sole proprietor that went to a 1065 or an 1120S, that's still continuity of self-employment. I don't care how you filed your self-employment, it's self-employment.
It is. It sure is.
Correct.
Yeah. I mean, in my case was specifically, it was still the same. It was a Schedule C on the 1040, all of them. And this woman was stuck on the name.
The only one little caveat. Yeah, that's crazy. The only one little caveat is I don't know why people would, and I'm sure they've met with their tax advisors, why they would have a regular 1120 C Corp, but let's just say they do, right? That there's a little bit of a footnote. If they have an 1120 C Corp, you obviously only get salary and any dividend that you get yourself. That's going to show up on Schedule B. So I'm not allowed to take, there's no such thing as a K1. So basically, if you're an 1120C, again, there must be a good reason why you're an 1120C for double taxation. But you're going, I see it. Believe it or not, I do see it a couple times a week. Yeah. Your income on a mortgage application is only going to be whatever you pay yourself and whatever the dividends are on Schedule B that you dividend yourself like any other corporation. Okay. So any questions? I know that's a lot. I know it can get really, I can geek out on this for hours. It's highly technical, but it's highly doable as well.
Yeah. Well, Pedro, do you have any questions? Yeah.
No, I was going to ask you, David, and I know you and I have had conversations in the past. One, in summary, if we kind of recap of this on the, how can a self-employed make himself or herself more attractive to a mortgage broker? Let's say like yourself. Let's say I'm coming to you now. What are the kind of bullet point, very, minimum? Pedro, you need to make sure of this, this, and this, and this. To make myself more attractive, to make myself, increase my chances.
Right. Well, that's a great question. Half of that is a regular standard answer, regardless of whether they're self-employed or not. And that is obviously the better the credit, the more attractive you are, right? Okay. So you got to pay your bills on time and don't overextend yourself, number one. But as it pertains to self-employed individuals, you've got to meet with your tax professionals, your CPAs like yourselves. If you know that you're going to be doing life events like buying a house, which is a large life event for most people, I highly encourage that you meet with your CPA like yourselves and tell them that this is something I plan on doing this year, because yes, we want to minimize our tax liability, but at the same time, the other side of that coin is we want to maximize our usable income or allowable income for purposes of mortgages. And there are also other ways of minimizing your tax liability through accelerated depreciation to get added back on the mortgage application. So that has a net negative effect, a net neutral effect on a mortgage application. No two expenses are necessarily alike on a mortgage application. A Section 179 or any other type of accelerated depreciation is not the same as taking, dry cleaning and selling their phone bills on a mortgage application. That's number one. I would say other than that, you want to make sure, obviously, you've got the down payment and the cash to close. You want to make sure that you've been in business for, again, 2 years or more is typically the barometer. Again, there are some slight exceptions for 1 year, especially been in the same line of work. But if I've got somebody who has a 620 or higher credit score, obviously the higher the better. I've got somebody who has 2 years or more in business, who's got, all their documents in order, that's working with a CPA, that can get me that information quickly so I can do the reconciliations. That's going to make my life a lot easier to do those calculations for self-employed individuals.
Okay, that's very good.
Okay, but again, you can achieve tax minimization through different strategies that have less of a negative impact on a mortgage application than others.
Correct. And that has been we had talked about in the past, is like the trying to maximize your tax deductions. But again, if you're gonna go into specifically, if you're informed, listen, I'm gonna be applying for a mortgage, which of the strategies are gonna be applied, you can still achieve the tax maximization and still qualify for a mortgage if it's done correctly. Like you say, maximizing maybe your Section 179 bonus depreciation, because you guys are going to add those back.
Right.
So the net effect, like you said, it kind of offsets instead of less expense or increase our, shift the expenses in other areas, which actually will have a negative impact. So no, that makes a lot of sense.
For example, home office deductions. Those are things that we can add back for a mortgage application. If you're actually using your car in your business and you're not writing it off, but yet you're writing off your cellular phone bill, I can't add back your cellular phone bill. But if you have a car expense, a lease, or an auto loan, and you've got 12 months worth of history that's being paid out of the business, I can add that back. So it's those little things that make a big difference sometimes.
Very good. Very good. Now, do you have any what you have seen on kind of horror stories of things that you see coming through? I know you and I have talked about
the war stories.
I don't know to what extent you can disclose, but I know that
I can't just tell.
things I imagine that you have seen. I know that Maria and I would talk about things that we see, especially when we take over other.
The whole show is about war stories, really.
Yeah, exactly.
So, because I know that it could be educational too, because if I'm coming in to you, and let's say I have the great credit score, I have the 2 years and plus, but I know one area in particular that I know that you and I have talked, and Maria, is like, when you bring those financials, and then the financials like, what is this?
Well, the two things that come to mind right at the top of the head are, number one is, there are a lot of people that think that because they set their own salary and they own the business, they're like, well, what do you mean? I make $200,000 a year. Forget about the $200,000 loss I have in my K1. I make $200,000 a year. That's my salary. And I have to say, but who sets that salary? And they say, well, I do. And I said, right. So that's why, it doesn't matter. You can pay yourself as much as you want a W-2 salary when you're self-employed. We're going to take that and plus or minus your actual net income and start from there, or net loss. So number one, that's probably the most popular one when people fill out an application on a self-employed individual, is they put their salary and they think that no matter how high that salary is, they should get approved regardless of the health and strength of the profit and loss statement. The second one that I see, and this is probably good. I know this is going to be a dwindling effect, but obviously during the pandemic, they had all kinds of SBA money that was going on. Whether it be the PPP or the EIDL disaster loans, and that created cash flow to people's business accounts, and in some cases personal accounts. And there were plenty of self-employed people that thought that you could use it to buy a house, and that's not necessarily true. You can't. There are rare instances where if you were buying an office building, you could use it, right? But that was very rare that I would see that. But most importantly, a lot of people were booking it as income. So, just because you get a $100,000 PPP loan doesn't mean that means $100,000 worth of income. It's a balance sheet event. It's not a profit and loss event, right? So we had a lot of people coming to us with, money in their hands from the SBA, wanting to use that for down payment or closing costs. We had to say no, or booking it on their profit and loss statement as income, and wanting that to go into the income averages. So those are kind of like the two things that I would say were probably the most popular kind of faux pas the last 2 years.
This is crazy.
Yeah.
People, I'm sure you've had some laughs on your, at your office when you see these
Right.
kind of tricks trying to be played,
Yeah, and some are, intentional, and some are really just misunderstood, like cancellation of debt income. Obviously, a lot of the PPP loans most of them are being forgiven if done right by their CPAs or themselves.
Absolutely.
That's not an income mortgage event, cancellation of debt. That's a one-time extraordinary thing. So,
Right.
it is, I chuckle inside sometimes when I see it, but my job is to really be, I try to be that consultant to them and explain to them. And there are many times where I have to get their CPA on the phone because we use that term lightly, by the way, CPA. Let's talk about that. So I've seen everything from a retail strip center store shop that says they do accounting and tax, call themselves tax professionals, all the way to, nothing against them, love enrolled agents, right? But there's nothing, you can definitely see a difference when I'm talking to self-employed individuals between a licensed CPA with credentials and education versus the other end of a bookkeeping company.
Yes.
So there are plenty of times where I have to pull people in their advisors into the conversation to say, hey, look, I'm sorry to tell you this, but you made a mistake on Schedule E and we've got to fix it. So I do see that, once or twice a month as well.
Wow. Yeah. But thank you for saying that, because this is something that Pedro and I talk about quite a lot, because there's just so many out there sometimes. But then, we are in a position to do great work, quality work, very ethical, high ethical work. And, you get these, random questions sometimes like, well, that person is doing it at a quarter of the price. Well, do you know what they're going to do for you? Exactly.
I never understood why somebody would entrust their financial situation to a bookkeeping service. Look, if you want to do monthly write-up work, that's fine, but eventually have a CPA every year that looks at it and reviews it, right? That's one thing.
Absolutely.
But if you're taking your tax returns every year and doing your tax strategy planning with somebody that has no credentials, that there's no barrier to entry, which I think is criminal, you're gonna end up in a bad situation at some point.
Yes, absolutely.
So
thank you for sharing that, David.
Of course, I see it all the time. All the time. Yep. And lastly, I want to say to my lending community, stop asking for CPA comfort letters. We're not supposed to be doing that.
Exactly. So
this is for my lending community. It's against your E&O insurance. It's against the AICPA. Lenders cannot ask for comfort letters from CPAs. You cannot ask a CPA to determine the likelihood of continuance of a business concern because they're taking $50,000 out of their business account to use for a house. It says it right there in the guidelines.
I'm glad that you brought that up.
It says it right there in the guidelines.
Stop asking for those letters.
Yes. We have Fannie Mae and Freddie Mac says it's the lender's responsibility to determine liquidity. And we have very specific calculations for that. So I apologize on behalf of the lending community if you get that request it won't come from us, but if it comes from other lenders, you should tell them, obviously, you're not supposed to be writing comfort letters.
Thank you.
Thank you for saying that. Thank you. This is awesome. Awesome.
Yes. Know that you have an advocate, former CPA, master's in accounting and tax on your side in the lending community and me, okay?
This is awesome. This has been such great information, David. This is invaluable. Truly, it's been such pleasure having you here.
It's been a wonderful time. I appreciate the opportunity to speak on subjects that I really, truly love, okay? So thank you, Marie. Thank you, Pedro.
I want to make sure that I bring up your information here, and I'm going to just read it out just to make sure that in our audio version, those who are listening can actually catch it as well. So guys, those of you who are listening to the podcast, make sure if you'd like to reach out to David, you can call 954-448-6153. That number is 954-448-6153. You can also email David, and that is David, DAVID, Shier, SHEIR, @movement.com. That's david.shier@movement.com.
Thank you again. Thank you so much.
Awesome. Yeah, it was very good.
This was really, really cool. Thank you so much for this
I'll come back
excellent information.
Have me, okay? Just let me know.
Yes, we love that.
Thank you so much. Okay, so we are at the top of the hour, so we are gonna, just wanted to make sure if there were any comments or in the chat or any notes here that I can read out. We have, one of our viewers is from the FICPA, actually one of my chapter colleagues, and David, you are invited to present one of these days at our chapter.
There you go, David.
I would love it. Anytime you want, just let me know. Just
I'll bring the contact information to my colleague, and he says great topic, and this is such invaluable information. Excellent, but too short. It's okay. We'll come back with more information. Yeah. This is a 30-minute segment because we want to be cognizant of everybody's time. Everybody's, busy. A 30-minute segment is doable for anyone that's on the go. And of course, we want to be cognizant of everybody's time that's committed here to speak to us. You have work to do. So with that, thank you, everyone, for watching us or listening to us. We appreciate you. And of course, I always leave you guys with the quote from motivational speaker Jim Rohn: "You are the average of the 5 people you spend the most time with." I hope that today we are the 3 people you spend your time with. And with that, we wish you all a wonderful rest of your week. And until then, we'll see you next week, Thursday, 10 a.m. Eastern Time.
Thank you again. Bye-bye.